All right, looks like we're at the witching hour. Check, check, radio check. We're back. If somebody wouldn't mind typing into chat or that you can hear me or that you can see me. Good, that's good. Thank you. Good. All right. So it's been a couple weeks since I last spoke, and that brings us to, we're probably a week behind, but it's the market update, which is really data from June. I'm sorry, July. And it's a rear view mirror look. And, I think it's timely with us heading into the end of the year that we should have our, pulse on the economy. It's an election year. There's a lot going on. So without further ado, we'll get started. But thank all of you for taking time out of your busy schedules to hop on. All right. So, the growth indices, who won the day was the Russell, which is small cap. So small businesses did well in July. And then it was followed by real estate, right? So it seems like that made a little bit of a rebound. And then we were into the S&P, right? Actually, this purple, yeah, is the Dow, not the S&P. The S&P did 1.21% for July. So, all the indices were up, except for the commodities, right? So for 1 month, commodities, oil, precious metals, wheat, corn, things like that just did not do well. But overall, it was a good month. But when we take more of a macro view and we look at, hey, how's the year been trending? And this is one of the reasons why you really gotta you know, have a strategy when, be in the market, not react to news, the talking heads. And that's part of why we've continued to do this so that we can take a real thoughtful look as to where we're going and where we came from without being influenced by day-to-day noise. So what does this tell us? The green, evergreen color green top won the day, which is the S&P. The S&P 500, last month up over 16%. So that is a heavily weighted index. There's some name brands in there, so that could be problematic. But the S&P is just really a index that I think, a lot of consumers have gravitated their investment choices to, but it's also subject to a lot of volatility, right? And I think not only do we see that in July with that little dip there, but you'll also probably recently in the last week or so have seen volatility as well. And that's what, when you start seeing volatility, think of the ocean, right? If things are smooth and calm and and everything's fine, right? We really don't get concerned. But when we start seeing chop, when we start seeing, swells, there's nautical terms that will say 3 to 5s, 4 to 6s, right? Those aren't too bad. They're right, they're noise. You get 8 to 10s, 10 to 12s. Those are real C's. Those are real variants. Those are things that cause you to sit up and take notice. And I think that's what sort of popped up a couple weeks ago, as we got into, August. And we'll talk about that when we cover August. But anyway, things look good for, if you were in equities this year as a portion of your portfolio and you're diversified in different strategies overall, your account should look healthy. I just did an annual review with a client yesterday, and and he had come on board the beginning of the year, and he's like, "How we doing?" I mean, I didn't really do a return, a rate of return, or an actual performance, but basically they were up more, and that was as I was updating data and looking at it, just on a high level macro look, the strategies that we promote at Professional Planning Services is to, the theory and the thought process should be, we want to get a reasonable rate of return that we can sort of count on without taking an abundance of risk to get to the same endpoint, right? And so, you can say, hey, I got 15% rate of return on my portfolio this year. Wonderful. Applaud. Bravos. But what was the amount of risk that you took to do so? And it's interesting. I'm sorry to digress here, but where I live down the street, they built a house, and those people put a chicken coop and started selling eggs right at the street corner. So it's easier for us to go down and give them $5, get a dozen eggs, and we're good. And my daughter was like, "Okay, I'll ride the bike down and I'll go pick it up." And me and my wife looked at each other and we laughed and we said, "Don't put all your eggs in one basket." And that's just, that's a little corny, but it is. That's where diversify, 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 but diversify with thoughtfulness. Diversify, you can, say I'm diversified, but a lot of times when we're looking at clients' portfolios that are either invested at a 401k, invested through their work, and maybe they have a couple holdings, but a lot of the underlying, holdings within an index or within a mutual fund are in the same exact stocks. So how diversified are you? So, again, I haven't talked about this in a while. I just wanted to say, hey, I believe in equities. I think we need to be invested. And I was just looking at a piece this week since I've been back. And, back in 2000, right, we had 3 down years. Has not happened in a while. Had one or two, but to have three is hurtful. And that was right at the beginning of 2000, the internet bubble burst. And then we obviously had 2007, 2008. And it took, quite a few years for that to come back, but that was deeper and hurt. So my point is that exposure to equity should be thought of as we need to be there. We need to get there with purpose, and we need to not listen to the news and be skittish. Right? It's hard. We're not robots, and as much as people would have you believe that we can be automated with our investing, it's very, very difficult when you add human emotion to the equation to actually beat out where the markets are going to go. So overall, this was good news. But one of the things that jumped off the page at me, I went back and looked at our charts from last month, and we were in a green, and now we have a red line. So what does that mean? It just means heads up. Just means all three signals have triggered the triple cross, the crossovers between the relative strength index, the moving average, and the convergence and divergence, the MACD, right? That all of these indicators are just signals that say, hey, we're getting signs that we're getting out over our skis, that we're a little concerned that we could see some downward pressure into the future. And that's why, again, why I do these things is to help give us a heads up that without a strategy, if you're still investing in your 401k at work, what do? Well, you seek professional guidance, right? Because everybody thinks that they have a plan until all of a sudden things go south. And then all of a sudden you're sitting around going, well, how did I allow my portfolio to correct 20% or 25%? That's real money. And so depending on where you are as you approach retirement, we have to protect our nest eggs. And that's why part of our philosophy, again, at Professional Planning Services, let's go into investing with a strategy. Let's agree on some concepts, and then let's go out there and be diversified to maximize where we can get safely. Like I said, 6% while we're working. Excuse me, 4% once we retire. Those are the numbers I shoot for. They're not pie in the sky, but I'm much more comfortable talking about these very easy, simple numbers than trying to have to explain to a client or somebody that I've been working with, how is it you lost 20, 30, 40% of your portfolio? And it's because when the market happens, it happens, and then human emotion kicks in. And we've talked about that before, where we don't want to believe that it's true. We want to say, I want to go back to the way it was. I'll get out right when I get back to where I was. And it is a fool's errand, right? Trying to catch a falling knife. I always used to use this analogy. What people tend to do is they grab it, they go, ow, that hurts, but instead of letting go, they continue to squeeze harder and harder and harder as it goes down, and it cuts deeper, deeper, and deeper. And then they go to a point where they can't get out, right? And that's okay, but the emotional toll is still there. So keep these things in mind. That's why we will continue to do these monthly calls, and we will be changing up our format a little bit. And we're heading into September. But we will have this on our agenda every month, and I just want to thank you all for being here. So now let's look at the income portfolios. And again, 1 month, if I was purely on a fixed income and I'm trying to get 4% and none of the indices are achieving that, what do you do? How do we do that? What happens if you've sat with an advisor, turn around and said, okay, we're going to pull 4% out of your portfolio, and the portfolio A is not even generating 4% unless you're in equities, but on the income side, it's definitely not been there. And then when you look at the averages for the year, this is problematic, which is why Pink has led the way, which is high yield, right? So just to get to the 4% that we're talking about, you have to take above average risk in the bond sector. So, again, I challenge some of the way that we have done things for the last 10, 20, 30 years, where that 60-40 and maybe ultimately 50-50, being in bonds, I like bonds to a degree, but they are subject to interest rates. And Jerome Powell is going to speak tomorrow. He probably won't cut rates tomorrow, but it is likely that he's going to cut rates in September. So as I've been speaking with clients, we have offered clients, something you may recall, something called MYGAs, multi-year guaranteed annuities, which are basically the insurance industry's version of a CD, with the benefit of where we don't tax the money in the year where it's gained. We actually are able to kick that down the road. So those features allow us to have locked in guarantees. So if you were able to lock in, I just locked in one yesterday, 5.4% for a 3-year, guaranteed. So what we use these contracts for are bond alternatives, right? If we're a little bit younger and we can afford some of the volatility, and over time, I do agree that we will outperform. But the insurance carriers, one of the things people don't quite understand, I don't think completely, is that they are masters. I mean, absolutely the creme de la creme of managing risk. And when they take their own money, their general accounts, which they must be approved in every state that they're licensed in, and they turn around and invest that, and they invest those in treasuries, in 30-year bonds, 10-year bonds. They are extremely conservative to lock in these long-term rates, and then to be able to say, based on what we're doing, we're able to offer this. That to me is real mitigation of risk, right? You are able to say, hey, listen, we could roll the dice, right? And we can do that on the equity side. Where I get cautious is the portion of our portfolio that is supposed to be balanced, that is supposed to be safe, that is supposed to be almost a seesaw component, right? When equities go down the way that it used to work, when equities go down, bonds were the safe area, so that would sort of recover and cover the downward pressure until equities came back. But what we've seen over time is now they're almost becoming too correlated, right? That they are actually, when they go up, they're both going up, and when they come down, they're both going down. So is it really the best strategy? And so what we've been doing in professional planning services is using the strategy of having bond alternatives. And it's not just with annuities. We can do so with things that we've talked about before, structured notes, or maybe putting in some type of buffered ETF that has an income. There are things that we can do, products that have been created to help us have that balanced portfolio. So I hope that made sense, but I just wanted to touch base because it's been a couple of weeks since we've been there. But again, one of the things now, so why do we have a green line on bonds? So remember, as interest rates go down, and they have been creeping down since the beginning of the year, or so I would say since second quarter, right? Bond prices start to go up. They have an inverse relationship, which is why all three tripwires have been triggered here to say if you're in bonds in a 401k right now, you will start to see some healing. But would I go dump new money into bonds? Me personally, and the answer is no, right? So it just understand. I know it gets a little complicated and complex, but this is why we have these calls to help you to sort of think through this stuff with a degree of logic that is quite often missing from the day-to-day talking heads. And then I wanted to just talking about the recession probability analytics tool, and anything over 50 says, hey, be cautious. It was 55 last month, says 56. This is, I think some recession fears have waned of late, that we're getting a little bit of positive news. Nothing, life changing as far as economic data. I saw something yesterday, which I found interesting. And now some of the media is talking about it. But the jobs report that came out and was initially reported was off by 800,000 jobs. Like, if your job is to measure the degree of employment, can you absolutely have no clue that you were off by 800,000 employees? So that negative number could come back and reflect in the markets as well. When you have an election year, you have Ukraine and Russia flared up. You have Israel, Hamas, Hezbollah. That's a hot spot with Iran rattling their saber. And although the United States is trying to put them in check, it just takes one FU to turn around and it's all bets are off. And our world as we know it today has changed forever. That could happen. So I don't have a crystal ball, and I'm not a fear monger, and I don't walk around like Chicken Little thinking that the sky's falling. But I am an ex-Boy Scout, right? So as a kid, I learned to be prepared. So having strategies that allow us to be able to be thoughtful in our investment strategies, to be able to not lose our shirts should something unexpected happen that we didn't plan for. And that's the purpose and the wisdom in dealing with an advisor that knows what they're doing. And then lastly, you got China. I got a client next week I'm going to see who's moving back to Taiwan. Her family's coming over here. I'm going to meet her, right? And China's looking to take back Taiwan. So I don't know how the U.S. is going to play a role in this, but we have an election year that is going to get heated. And here's the one thing I'll leave at this, because I'm going to leave the politics out of it, but do your own research. Trust your eyes. If somebody broke into my house and I see the front door kicked in, I don't need to go to the news to look at that and go, there's a problem there, right there. That was illegal. So that's where I sort of base my judgments on, is not what I thinks somebody's opinion is, and how they turn around and they point the finger at everybody else and call name calling, and that personalities aside, at the end of the day, I'm an American. I served in the military. I believe and love this country. I want nothing but good things for this country. One thing that scares the bejesus out of me, and I almost got into a fight on the soccer field one day because I used one word when I was coaching my daughter's soccer. And I said, Jess, push him out, because they were putting pressure on the goalie. So the guy sitting next to me on the field turns, no, coach him from the sidelines. Now, that aside, I dismissed that, turned to him, and I said, last I checked, this is America. And I'll say what I want, when I want, you communist. And when I said communist, that guy got up and stepped towards me. And I said, one more step towards me, and I will defend myself. Now, I don't say that to try and to share anything other than, we live in a country where you have to stand up for what you believe in, what's right and wrong. And we do all have that opportunity come this November. So check your soul, check your sources, and then what you think, and ask yourself. I've been doing this now since COVID, and I'm looking at the economy now, and I'm going, whoo. So no excuses. I just go, you know what? Was it better then, or is it better now? And I have my opinions. I'll keep that for another day. So with that said, where was I? I turned 60 on Sunday. I cannot believe it. And so, I was able to take my family and some of my closest and dearest friends, you see them there, my Disney characters, and go on a Disney cruise and have a trip of a lifetime. I was in Alaska, I was in Canada, I was on a cruise ship, I saw things. And I'll leave it with this because this really it opened my eyes. I was sharing this with Keith earlier today. That train right here in the lower right hand corner was a train ride that you take up, and it was the Klondike and the pavement in the terrain that we went through, that they built a train track on to go over and cross over the border and come back. And they talk about how desperate people were back then and how to change their life. They gave up everything to hike into the unknown, uncharted territory, the wild frontier, to make a better life in searching for that gold. And I hear this now, oh, they were promised that the roads were paved with gold. And whether they were coming from China over here and were solicited that bill of goods, or whether they were already here and there was a few people that found some gold in the rivers there. And I was in Skagway and I saw this terrain and I said to myself, right now, I don't know that if I dropped off this train right now that I could survive in this environment for any extended period of time. It starts to really start to check your perspective on where we were just 100 to 150 years ago as a society to where we are now. I'm extremely blessed, and I want to thank all of you for taking time every week to come out, allowing us to help and serve you. We will continue to do that. I'm not going anywhere. I'm sitting here. I eat, breathe, and sleep this stuff. If I can help you and your family, allow our family to help your family. And then we do have our next Social Security event. This has really been successful. We are, I'm meeting. I have another client meeting now right after this call, where people are genuinely. This is complex. Integrating Social Security into your income and your income plan as you segue into retirement takes skills. It's complex. It's not easy. You have to understand it. What's the right move? What chess piece to move? So with that, if you have not been, you would like to come, we haven't even opened up the links yet. Just send us an email, let us know. It was almost at capacity for both classes last time. And, you still got about another month and it'll be right around the election. So maybe you get a little bit more of my opinions as we go forward. So each and every one of you, I want to thank you. If you have any questions, please reach out. Most of you have my cell phone number. Call me. I'm here. I'm back. I'm going to be running here this last Q3, Q4. I can tell you, I was looking at my calendar and I am traveling. I'm running. But you know what? I love what I do, and that's why I will continue to do it. So everybody, have a great day. Thank you. And here's our disclaimer. We'll get started.